What we see is a shift. We see a shift, frankly, with FinTech and marketplace consumer currently trending downwards, while the more frontier tech topics, health, industrial tech, climate, and deep tech really moving up in relevance, also in terms of deal flow and quality of deal flow. The overlaying theme, of course, is AI. I mean, that's a no-brainer, but I have to say I never witnessed such a shift. I've been part of the mobile platform shift myself as a founder. This is the first time I really see it as a VC and in such a dramatic way. So if I look the last 40 deals we've done in Speedinvest, so we do roughly 30 a year. Yeah, 85% are AI first companies.
Hey guys, welcome to VNTR Podcast. Today we are hosting Oliver Holle as a guest. Managing partner, general partner at Speedinvest. And welcome, Oliver. Good to see you again. Thank you for hosting me at your event in Berlin during GITEX Europe. Finally, we met in person. Welcome on board. Please share about yourself, who are you?
Yeah, thanks for the invitation, Yuri, and really cool what you're doing with VNTR. And yeah, let's dive into this. So maybe quick introduction myself. I run Speedinvest. Speedinvest is a pan-European, by now actually a pan-EMEA-wide early stage fund. We focus on seed. We focus on the earliest stages of investing and built this now for 15 years. By now, we have roughly 1.4 billion assets under management, have approximately 400 investments, 400 portfolio companies across all of Europe and also Middle East and Africa. By now, we also run a growth fund, but the core remains the early stage. And that's also where I think the DNA and the excitement of myself remains. Yeah, I'm happy to speak about what I've done before, coming from an operator entrepreneurial background. So,
when did you start entrepreneurship yourself and what were your first ventures?
So I was actually doing my PhD at Columbia University in New York. By that time, that was in 97, so a long time ago. I was obviously still a student, graduate student, but already had a very tiny little business as a side that we launched as students during undergrad studies in Austria and Vienna. That's where I was born, and also studied undergrad business. This was a computer simulation games company. I wouldn't even call it a company. I would not call it a startup. This was just a sideshow where we earned some money. But yeah, then suddenly the first digital revolution came, and web startups popped up left and right. And we were actually not that badly positioned because we're one of the few people in Europe that did not just do websites, but actually had coding experience in creating a bit more complicated, complex games and simulations. So actually a lot of VCs knocked on my door. I was still doing PhD in New York, and they asked me if we would want to, build a real company. So I had a very important decision to make for myself. I was moving away from a more scientifically focused career path. I studied PhD in economics, so very different, very abstract, very theoretical versus full-on entrepreneurship. So I decided for full entrepreneurship, moved back to Austria and started my first company with two other friends. Actually, back then we were 6 shareholders, but only 3 of us full time. Yeah, and built this first company. So that was the very early.
Did you drop out from your PhD or you finished?
I dropped out. Yeah.
You see,
my parents were not too happy because I got a scholarship and everything. I did finish my master's, so to say, but yeah, I was already in the 3rd year of writing my thesis, so quite advanced. But if you understand the academic path of economics, it's such a long path, so long feedback cycles, and it was not for me. And the excitement and the thrill of launching your own company was much more tempting. But yeah, it was a rough transition from Columbia to New York to a two-room office in Vienna.
Why did you decide to build the company out of Vienna? Why not continue in New York?
My team was in Vienna. My customers were in Vienna and Austria. I had zero network to any kind of startup ecosystem in New York. That was very, back then, academics and the very nascent ecosystem and startups. I didn't even knew if there was any, to be honest. I was in my academic.
Yeah, you were not part of it. Yeah.
I was totally not part of it. I guess with similar to many other founders, you build your company with friends and with people you like, which also is probably one of the learnings that many entrepreneurs make that can work out, but it can also be very, very bad. And for us, it clearly was a mistake back then, to be honest. Yeah. So in reality, out of the 6 people that started my first company, I'm still working with 2. Almost 30 years later, I still see them every day. So that's very nice. But the other 4 or the other 3 that were also founders never really moved into the company, but we had them as shareholders. So that was, of course, created all kinds of complications down the road, restructuring and tough negotiations, tough discussions. So yeah, be aware of who go to bed with in entrepreneurship. That's clearly a lesson that has been said many times before, but I felt it personally quite a bit. Yeah.
And how many years did you guys build that venture?
So we started in 98 and then raised. I was still doing parallel PhD and this company. In 99, we fully committed and raised some money in early 2000, just at the top of the hype cycle, just a few weeks before the bubble burst. Did all the mistakes you could do, spent all the money we raised. Almost 5 million, which back then in Austria was by far the biggest amount any startup raised. Spend it all completely in the most ridiculous ways. I'm not going to go into all the details, but quite amazingly stupid. Yeah, we're pretty much bankrupt 1.5 years later. Had no more money in the bank. Had to take an additional round of capital from our existing investors. Were completely diluted. Survived. Fortunately, back then, mobile came along. That saved us. So suddenly, all the mobile carriers had money to spend, and we pivoted into mobile content, mobile messaging, and eventually landed on our feet. Had a large contract with Ericsson back then that was really taking our product global. And then in 2004, I bought out my investors. So I also got back into control of the company and merged my company with 2 other startups, also something quite unusual to do, because we all knew, okay, we were all subcritical size to create a meaningful exit, but together we were 80 people, roughly 10 million net revenues, highly profitable. So a very interesting asset in mobile in Europe. And that was the strategy. We merged. This company was then called 3 United. And the merger already was with a very clear intention to sell the business. So actually, when we finalized the transaction documents for the merger, we already hired an M&A banker to work with us on the exit.
How many years did it take you to sell?
1.5 years.
So it's also a lengthy process.
Yeah, it was deliberately that way. And that's actually something I can also give as an advice. So we didn't engage the banker in a straightforward M&A process, but we actually paid him for the first year only on BizDev. So we actually built quite nice commercial relationships with a handful of big US players, including VeriSign. And that was the basis then in the last half year to switch into a full M&A mode, but already on the basis of trusted relationships, already on the basis of commercial business done together. And that helped tremendously, and was probably a very good way to eventually sell the company. We had 7 term sheets on the table in 2006, and then decided to go with VeriSign, who acquired us. Nowadays, this doesn't sound big. It was a $60 million cash transaction, but for us, it was game-changing, life-changing, and a very happy ending of almost 10 years of building. And out of the 10 years, I have to say 7 to 8 pain, pure pain.
And what does it take to make a successful M&A transaction?
Optionality.
So like have multiple bidders?
Multiple bidders, ideally not cold start. I think selling to somebody that doesn't know your business, doesn't know you, is either you're very lucky or you will see a massive discount. For us, also a clear project management setup where one of us, actually me, was fully focused on that process, almost nothing else. And of course, plenty of time. The worst case, and I see it in my portfolio every day, worst case scenario is that if you only have 2, 3, 4, 5 months to sell a company and then you're bankrupt. then that's obviously a recipe for disaster, or at least a recipe for very low prices. And in our case, we were fully in control. We had multiple millions of EBIT. So we were in a very strong position. And we actually moved the price point from the first offer, which was below 30, to beyond 60, just because we could. And I see it over and over and again. Yeah, if you're in control of your destiny there, it makes a huge difference.
Do you think that it was the right timing to sell? If you would wait for a few years, would it be 120 or more?
We would have had to pivot dramatically because in 2007, the iPhone came along, right?
Yes, right.
So in that sense, we were quite lucky selling in 2006. On the other hand, could we have pivoted? We had a very strong team. And if I look at the people that are now building meaningful companies, a lot of them were in my company back then. So there was a lot of talent density. And of course, if you look at the exits that happened in the last 10, 15 years, this could have been a bigger company. But it's one of the typical European stories, right, of entrepreneurs feeling quite happy with 60 billion and not going all the way into building a unicorn or anything like that.
Yeah, so it's very important to sell at the right time.
100%. I mean, there was another podcast I recently listened to from a US VC that has already been in the market for 35 years. I'm only doing this now for 15. And he said that out of the 35 years, 80% of his returns came within 3 years. So you not only have the power law in venture within your portfolio, which obviously everybody has, including us, but you also have the power law on a temporal axis. Only a few years matter, and you better sell in those few years.
Yeah. But for example, with Israeli Wiz, right? They had the acquisition offer for I think like 20 plus billion. And they rejected it and waited for a year and sold it to the same company for 10 billion more, right?
Can also go the other way.
Exactly, they could fail as well. Yeah,
100%. Yeah, that's. But I think we were okay, and that gave us all of us the opportunity to build something new. It was also that merger worked extremely well, but it was clear that also from a cultural and personality perspective, this was only to last for a few years. We would not have been, this would not have been a setup for another 10 years, let's put it this way.
Did you have earnout as part of the transaction? No,
we didn't. We had a little bit, a very tiny identification clause in there. But public companies back then, were much preferred to pay cash in a one-time transaction because they didn't want to. Any kind of earnout transaction would actually make this a operational expense and not a capital expense. So it was actually in their interest to not do that, which we gladly accepted, of course.
Yeah. So what did you decide to do after?
I was a bit lost. I stayed actually with VeriSign for almost 2 years. I moved to California. That was fun. Moved my family, 3 kids. I've moved to Santa Cruz, on the West Coast. It was beautiful, and tried to understand how corporate works. It looks like I never had a boss before in my life, so I had that for almost 2 years. It was actually good. I was a nice guy, but then you saw the irrational, the craziness of public companies. Within these 2 years, they completely fired the executives that I've been building a relationship with. They were all gone. They decided to divest all the mobile assets that they bought. They bought Jamba, they bought us, they bought like 5 assets for more than $1 billion USD, and eventually they had to sell everything again. It was completely ridiculous. So after 2 years, it was very clear we need to go. I actually tried to buy back my company, but my offer was too low. And in hindsight, I'm very happy it didn't go through because it would have been actually quite painful. But yeah, so that was 2 years later. We had a baby born in the US in Santa Cruz. That was nice.
Why did you decide to leave California?
Family. So we had 3 older kids that wanted to go home. And that was actually a deal from the very beginning that we would only stay for 2-3 years max. A lot of the family was still back in Austria, and I would have stayed.
I lived 11 years in the Bay Area.
Oh, yeah. It's tempting. It's tempting at the same time. My personal experience, at least within VeriSign, was that my team that I felt 2 years later that the people I worked with in Europe were absolutely able to compete with their US peers. To the contrary, I felt my team, just looking at I oversaw all the mobile teams within VeriSign, which were ultimately 5 different companies that they acquired. I was very convinced that actually our teams were faster, more efficient, more capital efficient, less bullshit. So I felt actually that the opportunity is in Europe for me, also with my background, also with having now ties in Silicon Valley. So I felt that it's actually, I have more to win in Europe than being one of.
Less competition as well, right? At these years.
Yeah, more green fields, really green field. Nobody, very few people working in Europe that had that kind of experience. So that was while in the US, in San Francisco, I would have been one of many, many, many.
Exactly. Cool.
Yeah. So anyway, we moved back in 2009 and I then reconfigured my team, basically decided to keep working with the most trusted and brilliant guys from my previous company, and actually convinced one of the smartest guys that I met at VeriSign in Santa Cruz, who also came from a different acquisition, to also join us. And we built a small little advisory company with actually already one guy working out of San Francisco and the remaining back then 6 people working out of Vienna. And the idea was to replicate what we've done with Reunited, build bridges to the US market, help with business development, do some angel investing, and potentially see if we can replicate what we've done. The truth is, we tried this for 2 years and we came to the conclusion it's not working because we didn't have any capital to invest. I mean, we had our own money, but ultimately that was not sufficient to really build this out. So it was not working, frankly. So
you wanted to build another M&A structure, right, and sell it again?
Well, the idea was to advise companies to merge and then sell to the US. So kind of build critical mass companies by merging smaller startups in Europe and then help them pretty much replicate this Reunited story.
So it's more like a private equity play, right?
Or more like a micro private equity model, But micro private equity, just like private equity, doesn't work without capital.
Or revenues, or existing revenues, right?
Yeah, these entities would have had revenues, but that was not enough. We didn't have enough power to convince them or to make an attractive offering to really go into these kind of merger processes. It's a lot of learnings there. And ultimately, we came to the conclusion, if we want to stay in the startup ecosystem and not launch our own next operational company, we have to raise a fund. And of course, none of us had ever seen a fund from the inside. None of us had ever worked in VC or in finance overall.
And there was no education for VC at that time.
Yeah, of course, nothing. Yeah, I mean, what was available were, at least in Austria, a handful of venture firms, like actually 3, and all of them failed. All of them were actually winding down back then. So this was in 2009, 2010. So what I did is I had plenty of conversations with those partners and asked them, okay, what went wrong? What did you do? And then tried to learn from them, and they were very helpful to me. I'm still very grateful for that. But yeah, so out of these experiences, plus our operational experience, plus our experience with venture as founders, we tried to build a fund that we liked. And that was initially a very, very different model as Speedinvest. In the early days was much more a studio incubation model than a traditional fund. So it was a 10 million fund that we raised in 2011. And that 10 million fund actually had 6 full-time senior partners, right? That's completely crazy. So 6 full-time partners, 2 of them in the US, 4 of them in Europe, each of us going into portfolio companies on an operational capacity. So some of us took roles as COOs. I did sales, fundraising.
So very hands-on.
Super hands-on. And in turn, we got free equity in these companies in addition to the capital we invested. So it was a bit of a bespoke studio incubation model plus seed.
Was it successful cohort?
It was, the fund was very successful. It still stands at roughly, 6x, maybe it goes up to 8x, we'll see. Depends a bit on 1 or 2 companies that are still in the portfolio 12 years later, 13 years later. But we had very, very quick exits. So we returned the capital actually within less than 4 years. Had actually all our investors made money quite quickly. And in that sense, that gave us a mandate to continue building. Of course, not surprisingly, this model wasn't scalable. So it worked for 10, 15, 20 companies, didn't work for much more. So then in the second fund we actually jumped from a 10 million fund to a 90 million fund, so quite a big jump. And that was probably the toughest period in Speedinvest because we had to double the team. That was also, in hindsight, quite a bit a mistake, frankly. In my mind, I thought, okay, if I move from 10 to 90, I need to also double the partnership. So I brought in a lot more partners. So and a lot of them, and all of them actually that I hired were not coming from VC because there was nobody in VC at that point in time. Yeah, basically out of those additional six partners, 2 of them worked. So that's the reality. And that of course created a bit of turmoil because we had to also, the organization grew, the portfolio grew, and we were not actually set up to scale. But the second fund was back then quite lucky because we rode the wave of FinTech and we rode the wave of marketplaces and had quite a few early winners that we were lucky enough to be part of, like WeFox, Curve in the UK, Billy, Tier back then was a very exciting company, CoachUp. So at one point, the second fund had 5 unicorns, which was a bit crazy for us as an Austrian nobody, really.
And you, at that time, you invested only in Europe?
Only in Europe, yes. We only started to invest in a more structured way in Middle East and Africa 5-6 years ago. We did already in the first fund, in the Speedinvest 1, we already had an investment in Turkey with Payworks. EasyCo Payworks was not a fintech. That worked extremely well. So we already saw how it could work.
And what was it hard to raise the second fund? Because like most of the fund managers, they struggle with the second one, right? Because the first one, it's like you're emerging, and second one, they already look at your performance in the previous one, right? In the first one.
For us, the second fund was relatively easy. Because we had quite nice exits already. That was surprisingly fast. So we started the first one in 2011, the second one in 2015. And by 2015, mid-2015, we already almost returned all the capital from the first fund, which is unusual.
Was it because you were hands-on and actively helping these portfolio companies?
That was one thing. The other one was that we were actively looking for early exits. That you can do that for a 10 million fund. You can't do that for a bigger fund. But for that, but we knew, or we thought, okay, we need to prove that we create liquidity. So we sold everything we could in hindsight.
This is very good feedback, right? It's kind of emerging GPs, they need to have these quick wins, right?
Quick wins, and the quick wins can, of course, be up rounds. Back then, there were not that many up rounds to be had. So the much easier route was actually quick exits. Quick exits, not too, and our average entry valuation for the first fund was 1.2 million pre. So if you entered 1.2 and you sell the company for 20, it's a venture return. And that's what we did. We had a couple of those 20, 30, 40 million exits. Nothing spectacular, but actually TPI. So that was good. And then in combination of that was in 2015, 16, there was already a bit more interest in venture overall. There's so many disadvantages to come from a small niche market like Austria. But there's one big advantage actually that you have, that you're basically the only game in town. So for us, we were almost monopolizing all the capital that went into venture back then, and so the second fundraise actually worked fairly simple. I mean, it's never easy. Right?
I attended one of the first conferences in Vienna. It was the Pioneers conference. Yeah, I was there. It was 2014, I think, or 2013.
Yeah. I mean, the truth is, so the Pioneers Festival was actually coming out of an initiative that I launched together with a friend of mine. So the ecosystem in the end was so small. Everything came out of the same office, frankly. And the guys that then ran and then scaled Pioneers were basically working very closely with us because we had a little bit of a subsidy from the city of Vienna and gave it to them as a festival.
It was good ecosystem builder. I met a lot of good people there. Like Mike Butcher was just starting back then, and John Bradford was, just starting his springboard out of UK. Yeah, so we met back then.
That was cool, very cool. Yeah, that's. Let's see, maybe we reinvent it again. Yeah, so these were the early days. But we didn't. At that point in time, we still didn't have any institutional capital. It was all private investors, a lot of small angels, a lot of family offices, etc.
How did you transition to next larger funds? Right, so this is like most of the VCs, they don't get there to work with institutions. I suppose that like now you have more institutional investors.
Yeah, by now it's 75% institutional capital. So we took a detour back then. In 2017, actually, we had an opportunity to look into vertical funds. I had one very clear learning in these first years. A lot of things were not working, frankly. We didn't know exactly what we were doing. But what we knew is that sector expertise really is relevant, and founders actually appreciate that a lot. Stefan Glestil, who is my still up to today GP for FinTech, has been building this FinTech practice within Speedinvest, and he was at that point in time already one of the most desired partners to join an early stage round in FinTech, and that was really truly pan-European. So we tried to enter the London market, the UK market, and nobody knew us. But in FinTech, we already had a brand. In FinTech, people spoke really highly of us. So we saw the benefits of this flywheel if you have a really strong brand in a certain vertical, and you have a portfolio, and you know the banks, you know the insurance companies, and all of these things.
And did you structure it as separate funds or within the same fund?
Yeah, and then we were lucky, exactly. So, and then we decided, okay, obviously we couldn't build out all these sector teams from a small fund. So what we did is we raised dedicated sector-focused funds. We raised a marketplace fund back in 2017. We raised a FinTech fund in 2018, and we also raised an industrial tech fund in 2018. So this was a very important strategic step for us because it allowed us two things. On the one hand, building out these vertical teams and the expertise behind it and the portfolio behind it. On the other hand, building out the office infrastructure that we now have is a team in London, a team in Munich for the industrial tech, a team in Berlin, and by now also a team in Paris. This was very important. We found a way how to structure this that didn't create too many conflicts of interests and was actually well aligned and it worked for our LPs. Also, of course, a lot of the strategic LPs in those vertical funds came from their respective industries, so they had a specific interest in learning and working with these startups, etc.
How did you structure the incentive model for the GPs partners in such funds?
It's not so easy, obviously. And the way we structured it, we always had the flagship fund, the main fund, SI2, and then later SI3. And then we had these side funds. So anytime, for example, the marketplace fund would do an investment, 50% of the capital would come from the marketplace fund, 50% would come from the main fund. So there was this was not optional, this was fixed. There was no discussion how capital flows would look like. So it was always but on the other hand, only the marketplace fund was allowed to do marketplace investment. Same thing with FinTech, same thing with industry. So in the sense, the main fund was always co-investing in a structured way with these vertical funds. And that worked.
But you were not a GP in the side funds? Or you were also a GP in the side funds?
So we had one, as an organization, we saw ourselves as one joint group of GPs. And also the incentives were aligned in the sense that I had, or that the horizontal fund people had carry in the vertical funds and vice versa. So we were cross incentivized. Of course, the vertical GP in marketplace, for example, had the vast majority of his carry in the marketplace funds. So there was, I think it worked, but ultimately this was a very important part of our journey, but it was not the end state, because in the end state, we needed to solve for two things. First of all, institutional capital didn't like this at all. Too complicated, too many to think how this can go wrong. And second, ownership, right? If you start to raise bigger funds, you need big ownership. And the main fund, the horizontal funds, always shared 50-50 with those vertical funds in ownership. That ultimately didn't work in terms of having then enough ownership in the main fund to really return larger amounts of capital. So starting with SI3, that was then a 190 million fund. We started to reintegrate these vertical teams, stopped launching new vertical funds, and by SI4, that's the fund we raised in 2022, we completely got rid of the vertical funds and still kept those vertical teams, but actually invested out of one main group, which was then 350 million in size, so quite a lot bigger. And that's where then all the institutionals were happy to join because it was a simple structure, one seed fund, one growth fund, plain vanilla. So what you see is obviously Speedinvest is A, very, very entrepreneurial, and B, trying out new things all the time. But you have to also accept the market realities, and the market realities is institutional capital doesn't like experiments, doesn't like innovation. So ultimately, if you want to attract this kind of capital, you stick with the standard 220, 12 years, whatever model, which is, I don't think it's the right model for venture. I think there are a lot of things that are flawed around it, but we're not strong enough.
What is the right model?
It's a good question. I mean, one thing is timing, obviously. These kind of 10-year fund horizons are really unrealistic. Everybody knows it. Nobody speaks about it. That's one thing. The operational support model is extremely hard to pull off. And I don't think anybody has figured it out yet how to solve for it, because there would be so many benefits in building a massive support infrastructure for early stage startups. But the typical fee structure doesn't support this. And on the other hand, if you're extremely anal about conflicts of interest and about building out a bigger business behind venture, then which none of these institutional investors want you to do, then you also basically you have to stay with a very slim support layer of a few people that will not make a big difference, if you're honest about it. Yeah, there's no good liquidity market in venture. That's something that's a big problem. Yeah, and I think the incentive model is also a bit misaligned. If I think about, we are now raising relatively large funds, 350 million plus. If you look at the carry incentive, it moves away so far into the future that it's very hard to retain strong young talent because they do the math. And then you start to have to pay them enormous amounts of fee. I think there are a lot of ways to make this more aligned, more entrepreneurial, but you have to accept the realities that there are certain boxes that you work with.
Yeah. So you mentioned operational support model. From your experience, the top portfolio companies, did they really need your support?
I mean, the obvious answer is no, but it's not that easy actually, because the question is, what does operational support mean? When it comes to hiring, when it comes to marketing, those are probably the things that experienced entrepreneurs can really do themselves. But then again, you have, especially when you look in deep tech or when you look into industrial tech or health, you have excellent founders that really have not done anything like that before. So excellence can come in different shapes and forms. If you look at FinTech and SaaS and marketplaces, those commercial founders, they can do that. If they need help, then it's a problem. But then if you look at the other end of the spectrum, there are areas where top science-based founders could use some help. Even the most sophisticated founders still need a community, and they still need somebody to talk to and to learn from and see what others are doing, see our best practices. And that's, of course, something that we can provide, and we can create an environment of trust where these people can have an open conversation with other founders or with ourselves that they wouldn't be able to have somewhere else. So there's a lot of things.
How did you enable it kind of within hundreds of companies that you invested in? How do you guys manage the community? Do you have like events that you organize for them?
Yeah. Also learning journey. I mean, at some point we had an event in London with, I think, more than 400 founders coming together. That was ridiculous. Didn't work. So we moved back to much smaller events, and by now we have very, very specific events that never go beyond 100 people. So our flagship event is called Connect. We do that in the Austrian Alps in the winter. It's combined with a few days of skiing, and it's always focused on Series A companies that raise the Series A, not yet raised the massive B, but also not the ones that are just super early in the cycle.
We are also doing a ski retreat during Davos. Before Davos, we are doing 2 days for investors. VNTR ski retreat. Yeah, you should join us.
Yeah, that would be really fun. Yeah. Yeah, these things work. Of course, you have to make sure that you're inclusive. We have a lot of founders, especially from other parts of the world, that don't ski, but they love their nature. So you can go do all kinds of things. It's fine. But then we have vertical events. So each sector team builds its own event structure where they only invite health founders, only invite fintech founders, and then we do functional events where we invite all the CFOs or the CTOs. So much more focused and much stage relevant, because the one learning is clear. I mean, it's very hard to attract top founders from Series B and C's if there's nothing in for them. So yeah, I really have to think from each perspective.
Do you have something like Slack for all the founders, or like some WhatsApp groups? How do you guys manage?
We have, but doesn't work. We have a Slack group. It's used for propaganda messages, but that's it. No, small groups work. So there's a FinTech founder group, there is a marketplace founder group, a health founder group. So, and that has to be actively managed by the partners. And then of course I have my own group with my scale up CEOs that I know well. But we moved away from trying to manage 400 companies with probably more than 1,000 founders. It's divide and conquer.
Yeah, we are introducing committees, like sector focused committees for investors to connect with each other. Also, it's like smaller groups, also forum groups for investors to support each other. I agree with you about the size of the groups and relevancy. Relevancy is important for community.
Exactly, and it's a lot of work, but it's worth it. I think it's still so much more to do. It's one of those areas where I think there's still a completely untapped potential. Like board materials, good templates, all of these things, and of course AI will make a huge difference there.
Let's shift into like trends, and where do you guys see an opportunity to invest in right now? Like what are your focus sectors? Where do you guys see an opportunity?
So we continue to have these 6 vertical teams. So this is really covering all the core themes in venture, from SaaS to fintech to marketplaces. These were the traditional ones, I would say, to deep tech, industrial tech, climate tech, and health and bio, of course. So that remains the 6 teams. What we see is a shift. We see a shift, frankly, with fintech and marketplace consumer currently trending downwards, while the more frontier tech topics, health, industrial tech, climate, and deep tech really moving up in relevance, also in terms of deal flow and quality of deal flow. The overlaying theme, of course, is AI. I mean, that's a no-brainer, but I have to say I never witnessed such a shift. I mean, I've been part of the mobile platform shift myself as a founder. This is the first time I really see it as a VC in such a dramatic way. So if I look the last 40 deals we've done in Speedinvest, so we do roughly 30 a year, 85% are AI first companies. And of course, it's an extremely dangerous place to invest, because you don't know which of these companies will become irrelevant in maybe less than a year. But on the island, it's...
So how do you choose? Like, how do you guys make the choices?
Ultimately, we invest early stage, pre-seed, seed. So it's all about founder material and having a founder setup that either has an extremely clear advantage that is credible no matter what happens. So that maybe they come from science, maybe they come from health, or they have a specific vertical expertise that gives them an edge where they will figure it out in the vertical segment. Or they're just overall standout entrepreneurs that will win no matter what they do, in our belief. And it has to be either or, but you have to have extremely high conviction in the founder team and their ability to maneuver in this fast-moving space. So in my perspective, the whole AI revolution triggers an even bigger divide between the exceptional founding teams and everybody else. It's always been brutal, but now it's even more brutal. And you have of course a lot of repeat founders coming back now that are getting excited to play in this field. But even repeat founders, even successful repeat founders, is not enough. You then have to look very, very carefully under the hood, because there are a lot of repeat founders nowadays that raised a lot of money in 20 or 21, which does not necessarily translate into a clear signal of quality. But yeah, that's where the vertical expertise ultimately helps.
And also access to data, right? Kind of vertical data.
Access to data. Yeah, of course, the data, competition, who else is building, what are they building, what do customers really want? So that's one thing. And then the second part of the equation, for us at least, is AI and early stage, pre-seed seed AI deals are becoming so competitive in Europe. It's often not so much a question of if we want to invest, but are we able to invest? How can we get in, respectively, how can we lead? Because the very ambitious model of Speedinvest is that we always lead with very high ownership. So we wouldn't participate, even if we love the team and love everything they do, we would not participate as a follower. We always need to lead, which makes, of course, the bar quite high, because you have to then you compete against the multi-stage funds, you compete against the vertical seed funds, the other good seed brands out there. So it really translated from a move from a question of, do we feel comfortable to invest? How can we win, and how can we consistently win, and in a very short time?
So what does it take to lead around successfully? Can you share like some best practices?
I think the exercise is for both sides of the table. The exercise is to build trust extremely fast. And these rounds happen often within a few weeks. And so you have very few touch points. And within these few touch points, you need to convince yourself that this is one of those deals that you want to place a bet in. You need to build a relationship with the founder where they understand where you're coming from, and then see the very clear differentiated value. Because we're not the guys that have billions of euros behind us in follow-on capital. So our focus of value add has to be from this pre-seed first round to Series A, maybe Series B. And they need to see the value. How can you do it? By again, highly informed conversations. Highly informed conversations are only possible if you know your stuff. If you're a health tech founder and you speak with a generalistic VC, it's an uphill battle, I think. Either the person is so super smart and so credible because of other deals in the past that the brand wins. But in any other case, vertical expertise will make a difference. And then, founder references, of course, that's super relevant, both for successful founders and unsuccessful founders. And speed, being able to build up conviction within a few weeks because you already have a prepared mind.
So oftentimes some VCs ask founders, hey, do you have a lead investor? Or come back when you have a lead investor, right? It's a little bit like once they find a lead investor, they might not need you anymore, right? It's kind of you miss out on this opportunity. So like what recommendations you would like to give other VCs with this kind of mindset? What is the right way to collaborate with leads or not miss on opportunities?
Well, I think signaling is extremely important. People underestimate how important signaling is. So if I would be on the founder side, I would really focus on the leads first. And because the follower capital is typically the one that is relatively easy to bring together. And as a smaller angel or as a smaller early stage VC, it is again ideally building trust with lead investors through joint deals or showing deals that are extremely high in quality. One mistake I did in the early days of Speedinvest, I ran the same process for every company because I loved them all. And so I showed some ridiculous deals to, 20A and Sequoia, and that actually created negative
The quality wasn't there. Yeah, the quality wasn't.
The quality wasn't there, and that's not only a problem for the founder; it's a problem for me, because you need to be extremely curated which deal you show to whom, and only show the very, very, very best deals that you're 100% confident that they will raise a top round to those top investors, and then there is a second tier and a third tier. There's a brutal hierarchy in venture, and you need to know it, and you need to play your cards accordingly. And I think that's something I had to learn, because it also means you have to make founders unhappy, because they know that you have a close relationship, I don't know, with a big fund. And of course they expect you to do an intro, but you don't. Because you see, it will not work, and will only reflect badly on you and on me.
So you mentioned that you prefer to take fairly big stake in the companies as a lead investor. How much room do you leave for others to co-invest in the rounds? And do you have your own kind of mafia that you invite them first, and then there might be some investors from the founder eventually?
Yeah, exactly. That's the typical state. So we have a pretty strict rule that we need to have at least 13%, 13. That still leaves room, not too much room, but leaves room. Each of our vertical teams have their own value-added angels or co-investors that they can bring. But in most cases, the founders have also people that they want to see joining. And of course, there we are happy to accommodate.
Do you say no? Do you say no, we don't want these guys on the cap table?
Very rarely. I mean, we all have experiences with some co-investors that are really painful. And as mentioned, typically when we issue the term sheet and when we win the lead, filling up the round is not an issue at all. I stopped, for example, inviting my LPs to these rounds. That's another learning. It's too risky. It doesn't work well in the early stages. But there are so many good angels, good angel syndicates like yours that we can bring in. But very often it's actually driven by the founders, that they already have lined up 5 angels that are already soft committed, that it would be. And then there's the back and forth of who gets how much ownership and so on.
How do you participate in follow-on, right? So let's say you invested in Series A. What do you do in Series B stage or C? Do you participate or do you run it?
We always entered pre-seed or seed. We never enter in Series A. In Series A, we have roughly 50% reserved for follow-on in the seed fund, so we can easily do a pro rata. We have been increasingly more aggressive in also doing super pro rata, also helping founders with a significant bridge into Series A to extend runway. So that's clearly an ambition of ours, to build out ownership in the best companies over time. The seed fund stops at Series A. And then we have a growth fund that then takes over at Series B stage to either pick up our prata or potentially also co-lead. Do
you allow your LPs to co-invest, or only through the funds they can participate?
So in the later stages, we do. We show deals to our LPs, to the bigger ones, and invite them to co-invest, but not. We have done, I think we have 16 SPVs in the last couple of years, that we stopped doing that. Also in terms of, again, conflict of interest topics. If you have a growth fund, it creates all kinds of complications, like from which bucket to invest. So we stopped doing that. We still offer them co-investment opportunities, but without any commercial upside or benefit for us.
And in terms of exits, how do you help your portfolio companies to exit these days? Like the exit market wasn't great, right? So you do need to return money. Yeah,
super tough. And frankly speaking, in hindsight, we did clearly too little secondaries. That was a mistake. In 2020, 2021, we could have done quite a few more secondaries at the height of the cycle. We should have done that. We were not prepared. So what we launched in 2022 then, after that learning journey, so we have a small 2.5 full-time equivalent team that we call the TPI unit. The only thing these guys are doing is screening secondary opportunities. setting up continuation vehicles and helping on smaller scale strategic M&A. And that has been really super beneficial.
We are introducing our own secondary marketplace for the community soon, so that we can enable more liquidity between the different stages of investors within the community. Yeah,
I think this is super important, and we're just closing 2 continuation vehicles as we speak. It's nice. It will be a very important part of the venture model going forward, and that's of course where our scale helps, because if you're a small seed fund, there's no way you can justify that kind of team. But with our model, I think it makes a lot of sense, because it's.
How does continuation vehicle work? Is it like a vehicle that buys out the previous portfolio stakes and gives liquidity for the earlier fund?
Exactly. In a nutshell, yeah. So basically what happens is you bundle, let's say we have in one of our old vintage funds, we have many portfolio companies, and then we bundle 5 companies and create a strip sale that is bundled in one new vehicle. And then we look for a lead investor, a cornerstone investor who prices it, and then we can syndicate other investors into that vehicle.
And then buy out, kind of give that liquidity.
Exactly. And then exactly. And then our LPs get liquidity just like any other secondary transaction.
Why do you bundle it as a group of companies, right? Why not per company?
We learned that that's more attractive. We also do both. We have a lot of direct secondaries as well. That's another job of this team. But we learned that especially more sophisticated financial investors prefer also a little bit of risk diversification. So they look at our portfolio and say, okay, these 5 companies, maybe one company has a lot of upside, maybe one company has a quick exit, one company that is already pre-IPO, and then they can do their own financial model and find the right risk reward profile, and then you need to agree on the discount, and it's a very specific financial transaction that we didn't have the skills to do in the past, but now we learned it.
We see some GPs are like have LPs that want to exit, and in a way it's like similar, but it takes the whole portfolio, right, across the whole portfolio. But they're still the winners, right? The winners typically, like 80% of the value of that LP is the winners in the portfolio. Yeah,
exactly. Yeah, we've done that as well. We've also had LPs that needed liquidity, so we sold the LP stake. So it's a whole range of instruments that you need to get familiar with and build.
And you have to have an experienced team to do that.
Exactly. There is nobody in Europe that knows how to do these things. So building this expertise is actually quite useful. But it's a good. We should have done it 2 years earlier. But yeah.
Listen, you are building. I guess for the next 20 years, you're building that entity. So yeah. And to wrap up, what do you do for kind of fun or like for lifestyle balance or work-life balance? What do you like to do?
Too little. But yeah, I'm now very much looking for summer. I have to say. So we have a house in the southern part of Austria, where we're on the lake. I very much enjoy water skiing, so that's what I still do quite a bit. And meeting a lot of friends there that have nothing to do with venture and don't know what I do, and just
not founders of your portfolio companies hanging out with you.
That don't care about my professional life, but just care about being friends. That's healthy. Yeah.
Good. Thank you very much for joining, and we'll share this your story soon with our community. Join us in our Global Investor Summit in Lisbon during Web Summit. You should visit us in Portugal.
Yeah, very tempting. Portugal is so beautiful.
Yeah. And we are also launching Clubhouse in Portugal. So like there will be Venture House in Portugal. So
oh really? Okay.
So you should visit in Cascais. It's 25 minutes away.
I know that I've been there. Yeah, super nice. Yeah. Okay.
So know that you can come and stay there and enjoy meeting other investors and top entrepreneurs.
Cool. No, I'll pick you up on this. I love Cascais is a laugh. Yeah, it's beautiful. Yeah.
Thank you, Oliver, and have a great day and see you soon.
See you soon. Thank you.